Federal Reserve finds the meaning between a rock and a hard place. Here's what you need to know before the bell. This morning, we're going to get the inflation print for February, and of course, this is going to put the Fed in a very tough position between needing to cut rates in order to bail out the financial sector, but also hiking rates in order to combat inflation, and you can't have it both ways here. Unfortunately, if the Fed decides they need to cut rates or to pause at least to help support the financial system, well, that's going to potentially set up for a surge in inflation as easier money comes back into the financial system. Of course, the other side of this coin, if they continue to fight inflation, the risk of more banking events becomes a higher probability. So what's the Fed going to do on the 22nd of this month? Not sure, but this is going to be really interesting, and it will be driving markets here in the short term. Now, yesterday, the markets did rally off important support. In fact, we had talked about support being at these December lows, which is exactly where the market held support yesterday, rallied off of that from the morning. This morning, futures are again pointing higher here. Banking sector start to recover a little bit following the bailout by the Federal Reserve and the Treasury. This, of course, is also going to set up a retest potentially of this 200-day moving average, which was support, now very important resistance for the market. So over the course of the next few days, and again, CPI will likely drive the market this morning. If it comes in hotter than expected, that's certainly going to suggest the Fed's going to need to keep hiking rates despite what's happening in the financial sector. That would certainly weigh on asset prices. If it comes in much cooler than expected, well, the markets are likely going to like that, suggesting the Fed can ease off here a bit, which would also help the financial sector as well. So again, a lot of focus this morning will be paid to the inflation data, but then next week on March 22nd is, of course, the next Fed meeting where they will be determining whether or not to hike rates. So everything will be focused on what Jerome Powell says at that meeting. Over the next few days, though, I would expect the market to really kind of remain confined to this trading range. We remain on a sell signal. We were very close to triggering a buy signal here. That failed because of the sell-off in the markets. Looks like we're going to come down and test lower levels on that sell signal. The market is very oversold here short term. So again, this bounce that we're going to get in the next day or so, just an oversold bounce. Use that to sell into, reduce some risk, reduce your financial exposure for right now. And then once we kind of get through this problem in the markets over the next few days, we can look where to rebalance risk and how to do that. But right now, it looks like money's starting to flow not only into bonds, which had one of the biggest moves since 1987 yesterday, but also into technology and growth stocks, which have less exposure to interest rate risk. So we'll see kind of what happens here over the next few days. Just trade cautiously. Don't take on too much risk, but also at the same time, don't panic here. Markets are still holding up fine, even with this sell-off in the markets. Markets are doing just a normal correction after a very big rally that we had from last October. I'm your host, Lance Roberts, and that's what you need to know before the bell.